Alright guys, so chapter 5 is about the investment management front office. Can anyone tell me what they know about the investment management front office? What is that? What is it? What do they do? Yep, they make the investment decisions and the trading decisions. So when you think about the front office, you're thinking about portfolio managers, traders, analysts. You know, people who are involved in making sure the fund gets a positive return. So as it says in the slide here, front office functions involve making investment decisions and implementing them via trading. We also touch base on back office functions here because that's the next chapter. Back office functions are composed of administrative, record keeping, and reporting activities. Okay. So the investment management cycle, the front office falls into two major groups: what to buy and what to sell, and trading decisions. Okay? They are the primary factor that drives the performance of the fund. Okay? So what to buy and what to sell is pretty straightforward. Am I buying Apple stock? Did it go up? Okay, we made money. Where did trading decisions come in? Why is that important? No. There's a risk component to it, but you're not valuing risk when you make a trading decision. So let's say our analyst looks at the portfolio and says, we need to buy more Apple stock. Okay. Where does the trading decisions come into play? If you don't know, that's okay. You can all say, I don't know. Okay. So if you're a big portfolio manager for a big fund, right, or a small portfolio manager trading in a stock that is not very liquid, what can happen is that you can buy a stock and affect the price by you purchasing so much. None of us here in the classroom are going to, I hope one day you guys are capable of this, but let's be honest, none of us here can move the market. What do I mean by move the market? We can't buy a stock, and by us buying a stock, change the value of that stock. Warren Buffett, though, on the other hand, when he buys a stock or a company or makes an investment in a company,
changes everything.
It shoots up for a variety of reasons. One, because of his name. Two, because of simple supply and demand economics, right? When the demand goes up, even if it's just one person buying a ton of that stock, what's going to happen? It's going to cause the price to increase. So when traders make trading decisions, they might try to buy into a desired position over the course of anywhere from a few hours to a few days. And they'll often trade in blocks. They won't just buy, all right, we need to buy 1 million shares. They won't just drop all the cash and buy 1 million shares. What they'll do is they'll do it in smaller increments as to not alert the market about what they're doing, Because stocks are bought and sold in massive amounts all day, But if one person at one time, or one organization at one time, buys a huge chunk of stocks, guess what's going to happen? The price is going to shoot up, and it might make it more difficult to do the trade. And when your analysts made their decisions for you to purchase that stock, or security, whatever it is, they did it probably based on a certain price. But if you buy too much of that stock, enough to drive the price up, it may no longer be an attractive investment anymore. So when dealing with a Goldman Sachs, or Warren Buffett, or State Street, or any of these, or BlackRock, any of these big companies, right? You just have to be really careful about your trading policies. And even when you sell, right? When you sell the stock, you don't want to just dump it all at once, right? Because what's going to happen? It's going to cause downward pressure on the price if you're a big enough investment manager. Now, if you're a small investment manager, it's not going to make too much of a difference, right? But even if you're a small investment manager, and let's say you're trading in some frontier market. Do you guys know what frontier markets are? Frontier markets are below emerging markets. So,
startups?
No, so Brazil's an emerging market. But Ecuador would be a frontier market. And Colombia, I think, would be a frontier market, right? They're a step below, Brazil, China, India, Russia, which are traditional emerging markets. But frontier markets are a lot of
third world countries.
Third world countries. Go ahead. Yes, sir.
If one person can buy the stock and drive the price up, can't they just like buy it, drive the price up, and then just sell it and make a profit over and over?
No, because as they buy it and drive the price up, it's being driven up as they purchase it. So when they buy 1 million shares, they're buying those shares from people selling the stock. Generally, there's never an instance where somebody's buying 1 million shares and selling a million shares at the same time, where it will be like, oh, great, perfect match, So generally, you're like, all right, I want to buy 1 million shares of Apple. What's going to happen is, people will be putting in sell orders, right? And as they put in sell orders, like I might sell 1,000 shares, right? Is that going to fulfill the order? No. So more and more people are going to have to, a lot more sellers are going to have to fill that buy order. So as the sellers go to fill that buy order, the sell price is going to go tick up and up and up.
With these sell orders, how do they obtain them? Like, if there's 1,000 investors trying to get a certain X amount of stocks of a certain company before they actually, who they know who to give it to? Like, is that generated automatically?
Done through, what are you talking about, like the transfer process? And how it's all done through like electronic clearing houses, brokers, all handle that. So when we talk about the T+3 trading, why does it take 3 days for it to clear? This is part of the reason, right? Does that help?
Yes.
Okay. Investment management, analysis, and portfolio management. Analysis is the processing of data for useful information used to identify buy and sell opportunities. Portfolio management means to make buy and sell decisions based on analysis. In large firms, these processes can be completely separate departments, right? In some companies, like a State Street or Goldman Sachs, the analysts and the portfolio managers might not even sit in the same floor. But in a very small firm, they all might sit in the same row of cubes. It just depends on the organization. A lot of times they're along the same career path. Like anyone in the front office, if you're doing analysis, right, you could, go into portfolio management, right? Or you could go into being a trader, On the other side, there's like the relationship management side, which is harder to transfer over into like a portfolio management or a trading role. So this is also talking about different career paths in the mutual fund industry. Active managers trade for 2 reasons. Hint, hint. That's a good quiz question, right? To improve performance or to respond to cash flow needs, right? If somebody wants to sell out their position, the portfolio manager is going to have to sell some securities. So what? So you can get cash, right? When you want to sell, he's not going to say, oh, here's all your stocks, right? He's going to say, here's your cash. So that's how that works. So to improve performance and to respond to cash flow needs. Equity analysis. The analyst will attempt to find market opportunities for active PMs, right? AKA mutual funds. They can focus on many subsets of the market. So if you did like a job search, you might see for some kind of research analyst in an equity firm, you might see a wide variety of analysts. Like, oh, we're looking for a research analyst for retail electronics or biotech, And they're looking for somebody whose specialty is analyzing this type of sector or this type of industry, right? Because, if you've, done retail analysis for 10 years, you might have the same skills, but not the same background as somebody who's been researching biotech for the last 10 years, right? It's 2 completely different animals in terms of business model, right?
Yeah.
Okay. 2 important things to note here. Quantitative analysts and fundamental analysis. Okay. Quantitative analysts focus on financial ratios as well as other calculated data to perform analysis. So they'll use stuff, we're talking about like price to book ratio, price to earnings. There's hundreds of different ratios. There's interest coverage ratio, cash flow ratios. There's too many to list. I'm not going to make you memorize any ratios. Okay, at least not now. Fundamental analysis involves attempting to understand the company by reading industry reports, interviewing management, and also rate where the company fits into a specific industry. How would you guys describe the difference between quantitative analysts and fundamental analysts?
Quantitative is very specific and fundamental, like in general.
Yeah, that's a good way to describe it, right? Quantitative analysts are very numbers oriented. Not to say fundamental analysts aren't numbers oriented, right? Because they're still looking at the financial reports that come out and stuff like that. But as I told you before, there was an example of my company, right? We had a large position in BlackBerry, right? Which we can probably agree right now is not a good company to own, right? Why do they own it? Because their quantitative models said it was a cheap stock, right? But if you were a fundamental analyst, you would look at that and say, you know, hey, it's a cheap stock because it's going downhill. You know, maybe it's cheap for a reason. And you would kind of maybe talk to the managers, read some reports about what's going on inside the company, where a pure quant analyst will just say, by the numbers, this looks good, buy it. And it's usually not a person doing that. It's usually a computer program that's kind of spitting out the securities to buy or sell. And most firms, including the one I work for, don't necessarily have a hard and fast rule about, you know, pure quant or pure fundamental. A lot of shops are a little bit of both, right? Many funds are not purely one or the other, as I note down the bottom. Okay. Investment decisions have to abide by several regulations, 1940 Act, the prospectus rules, and the stated fund policies. So you have to obey the rules that you were given, right, by the government, right, the 1940 Act. And what comes to mind immediately, although I won't have you know this for a quiz, is the rule where you can't own more than 10% of voting class shares in any company, right? Because that would give the mutual fund companies kind of too much power. That's the idea behind that. Because these mutual fund companies have a tremendous amount of money, right? So if they could buy more than 10% of any company, they would be like the owners, right? They could start to be the owners of these companies because they just were investing for their clients. So that's what that's trying to prevent. Prospectus and stated fund policies. If you're an emerging market fund or an international fund or a domestic equity fund, guess what? You have to stick to what you said you were going to invest in your prospectus. That's all it's saying right there. Fixed income analysts and portfolio management. Fixed income funds can also be actively or passively managed. Something to note here with fixed income funds, the debt market, which aka the bond market, is nowhere near as liquid as the equity market. So when you have a passive bond fund, it's matching the benchmark always by sampling. It's never a pure replication of the bond index because they're almost impossible to replicate because a lot of these bonds are liquid. Because a lot of times when people buy a bond, they do what? Hold it to maturity, right? You're not day trading bonds, right? Generally, you're going to buy a bond and hold it until it matures, which could be anywhere from less than 1 year to 5 years. In some cases, there's 10, 20, 30. I think Disney had a 100-year bond they sold a while back. 3 common approaches for active managers to use. Duration adjustments, right? What is duration? I will ask you that on a quiz. Duration involves predicting future movements in interest rates. If interest rates are expected to fall, they will lengthen the maturity of the portfolio. Okay. Duration, I want you guys to look this up, and we'll talk about it. We will have another, I don't want to do this and have another quiz next week, even if we cover a lot of materials today. Duration involves the length of the time in the aggregate portfolio, right? So what's the average maturity? It's something along those lines for the sake of this class. Okay, relative value analysis involves the analysis of the yield spreads, right? What's the yield spread? Okay, when we consider what the risk-free rate is, we say it's close to what? A T-bill. What's a T-bill?
Treasury note.
Treasury note. It's a government security, right? They pay very low interest, but they're what? Very safe, right? So that's considered the risk-free rate. So if we had a Coca-Cola bond, do you think there would be a big spread between the Coca-Cola bond and the T-bill?
No.
No, why?
Coca-Cola is widely known.
Not because it's widely known. I would say I'm just as confident that Coca-Cola is not going to go bankrupt as I believe there's not going to be a civil war in the U.S. tomorrow and the U.S. is going to disappear. Right? There's about the same odds. So Coca-Cola debt and T-bill rates are going to be relatively close compared to other securities. Right? Now, let's say I'm comparing T-bills with American Airlines debt. Would we expect a small spread or a big spread? Big spread. Why?
American Airlines stocks.
Yeah, because American Airlines files for bankruptcy every 2 years, right? So we'll expect to see a big spread there, right? Why? Because we're taking on a lot more risk, so we're going to demand a higher return. Okay. However, would an analyst, let's say, buy the American Airlines bonds?
Sure.
Maybe, maybe not. If it goes bankrupt every 2 years, they might look for similar securities. They might look at, let's say, a Netflix bond, right? Which pays the same interest rate.
I think they're in trouble now, actually.
What, because of that Comcast thing?
No, because they're actually losing a lot of the.
The stars? Let it
No,
go.
no, not the stars. They're losing a lot of the rights to the movies, and there's a bunch of movies that are going to be taken off Netflix.
Yeah, they were actually taken off tonight.
Disney movies. Yeah, it's a bunch
They're all being taken off tonight. They had a long-term contract with Stars, like from 4 or 5 years ago, where they got a lot of content really cheap. They basically got to replicate Stars, the pay channel, and contract went up for renewal, and Stars wanted like 10 times the contract value of the original value. Now you can make the argument and say, well, streaming's more popular and blah blah blah, and there's value to it, but should they pay Stars 10 times? Are the movies on Stars worth 10 times more?
No, absolutely not.
No. So what are they going to do? They're going to tell Stars to see you later, and then what they're going to do is they're going to deal directly with the movie publishing houses to get more content that way. They won't be replicating Stars, but I mean, if I go on Netflix every other week, I always see like new movies that I'm like interested in seeing. I'm not going to get into a Netflix discussion now, but that would be an example of how they do an analysis, right? They say, all right, well, American Airlines pays 8% interest, but so does Netflix. Which one's a safer bet? And they would do an analysis and say, well, we think for a variety of reasons this is a better company. Issue selection can have numerous factors such as undervalued fixed assets, upgrades and ratings, and prepayment analysis. So upgrades and ratings, all bonds, I should say most bonds, are going to have a rating, right? And they might be on the verge of an upgrade or a downgrade on their debt rating, right? Their debt rating is kind of like our credit rating, right? If we're getting a higher credit rating, we're going to expect to pay a what?
Less.
Lower interest. If we have a lower credit rating, we're going to pay a what? Higher rate. So that's all part of the analysis here too. So they might sell bonds that say, all right, we think this company's going to get downgraded. We think their debt stinks, and they might go bankrupt. We're talking about American Airlines, and there's a higher likelihood of bankruptcy because of oil prices, and we think Moody's is going to downgrade their debt. So let's sell it. Does that make sense? Yeah. Two types of analysts in bonds. Credit analysts, they resemble fundamental analysts. They're looking at like kind of the general stuff, the news, the outlook of the company, the news reports that come out, and they're kind of making credit decisions. Like, all right, do we think this company is going to do more poorly or better, and how is that going to impact the price of the bond? Now, if a bond gets downgraded, and it's already been, here's the thing, right? If a bond is already issued, right? The company's already sold the bond, right? And it's on the public market. It doesn't matter so much to the company if their debt gets downgraded unless they plan on issuing new debt. Kind of like if you get a lower credit rating, it doesn't matter if you don't plan on taking any loans, right? Because let's say you bought a car and you had a high credit rating and then you trashed your credit, right? It's not going to affect your current car payment, right? Because that's already signed, sealed, and delivered. It will only affect future borrowing, right? So when a company gets upgraded or downgraded, it's going to affect future borrowing. How that affects us as investors is this. if we own the debt and we don't plan on holding it to maturity, it could affect the par value. Like if I wanted to sell my, when a bond's issued, they're usually issued at $1,000 a bond for the most part. Okay? Now, they're usually sold for $1,000, on their release day. And depending on how the risk-free rate changes and their credit rating changes, the value of that bond can go up or down, right? So right now, my Netflix bond is worth $1,100. Because why? Because that means the market thinks that 8.5% interest is too high. So they can't lower their interest rate. Netflix is going to keep on paying that 8.5% interest. But if I were to sell the bond, I wouldn't be selling it to you for $1,000. I'd be selling it to you for $1,100 above face value. I'd be selling it to you at a premium. So $850 over $1,100 is what? Sorry, $85 over $1,100 is what? Someone pull out the calculator?
$85 over 1,100.
Yeah.
0.07%.
Is it exactly 7%?
0.077727.
So 7.7%, right? So because the bond is selling at a premium, the real return you're going to get on that bond now is about 7.75%, right? Does that make sense? Yeah. Okay. Quantitative analysts develop and run math models to help them understand the behavior of the bond portfolios. So again, this is quantitative analyst in the bond market is the same as or similar to a quantitative analyst in an equity market, using a lot of heavy computer math models to make the buy and sell decisions. Trade order management. This is what I was talking about a few minutes ago with buying and selling decisions. The actions taken after the investment decision is made, right? If a large trade is made in a small equity it can have a substantial impact on its price, right? I don't have to repeat what I said earlier, it's the same concept, okay? And that goes the other way around too. If a large trade is made, if a very large trade is made in a large equity, it can still have an impact on its price. Mutual fund traders attempt to get the best execution. What do I mean by best execution? They're going to try to get the best price for their trades, right? Because it's going to impact how well the fund performs. Okay. Broker selection. Okay. Brokers seek out counterparties for trades. So this is what we were talking about a minute ago when you said, well, how do they match everything up? Brokers seek out counterparties for trades, right? They seek to match the buyers and the sellers. Brokers can also help purchase shares to assist in block trading. They deal with market effect. Market effect. I would know what market effect. I'd put a star next to that. What is market effect? Okay. Market effect is exactly what we're talking about here when a large trade is made in an equity and it changes its price. That's the market effect. Okay. But you guys can also look that up in the books through the reading. Okay. Soft dollars. Okay. A good question I might ask on the quiz is, why are soft dollars controversial? Okay. And I'll tell you why. So when you select a broker, the broker might give you some kind of incentive to use them, right? Because at the end of the day, the brokers are a fee-based organization too. You know, they're making money off fees, so the more business they do, the more profits they make. So they're going to try to entice institutions or clients to use them as the broker. So soft dollars are funds that are directed to certain brokers, and some of their fees, did I even write that correctly? Funds are directed to certain brokers, and some of their fees are exchanged for research. Okay? So the brokers might say, all right, well, if you use us as a broker, we'll give you this research in your area of expertise. We have a lot of these complementary research services that we can provide you, right? But you pay a higher fee for these services, right? Those are called soft dollars. What has happened?
It's controversial because it's misleading.
What has happened is that they provide research with soft dollars. But the research, if you're my client, okay?
You're supposed to give me research either way.
I'm supposed to get the research. If I'm trading for him and my client is paying the broker fees, because that's who's really. Even though I'm paying the broker, who's really paying the broker? My client, right? So the research can only be used for the benefit of the end client, not for the benefit of the mutual fund organization. So what's happened a lot of times is that the mutual fund will take the research, but they won't use it for the direct benefit of the client. Maybe it'll be for a different subject or a different equity class the client's not interested in. Other times, soft dollars have been used for more inappropriate stuff, like the broker will say, oh, well, if you use us, pay us soft dollars, we'll give your office all new computers. Right? Is that an appropriate use of soft dollars? Does it benefit the client?
Yes.
But does it directly benefit the client? No. And that's a question you have to ask. That's where soft dollars become controversial, right? It has to directly benefit the client. Now, for example, we do research, right? And we watch MSNBC to do research. If the broker, and this has happened too, if the broker says, oh, we'll pay your cable bill, right? Does that directly benefit the client? No. Is everything on MSNBC geared towards my client's investments?
Also, because it doesn't directly.
Has to directly benefit the client. Okay? But that's where it can get tricky, okay?
So soft dollars is a name for research?
It's a name for fees paid for research
Okay.
to brokers. Okay. Trading venues. I probably won't ask you too much about this, but exchanges are equity products can be traded on an exchange over the counter or through a crossing network. A crossing network will occur when there is two big organizations and one's looking to buy, one's looking to sell. If they can do like a quick trade between themselves, they can save themselves some fees involved in trading. Okay? So that's what a crossing network is when they can actually match a client up with another client for a buy and sell. So when I was at State Street, crossing was a big business, right? Because it saved the firm a lot of money when they could cross. So if there's one client who wanted to dump a certain security and there was another one who wanted to pick it up, there could be a crossing opportunity. That means State Street could just internally move the stock. They wouldn't have to go into the open exchange to make the trade, right? They could just internally transfer ownership. International trading can be tricky, right? Because trading in certain markets is not allowed for the U.S. citizens, right? I think, trying to think of one, like Colombia I know is a country that you get, as an American, you just can't go there and trade Colombian securities. Or I think China, there's restrictions on what kind of securities Americans can buy. I think you're only restricted to like H-class shares, which are like non-voting. Basically, you can buy ownership, but you have no control. So, in the different ways, you can get, more rights in terms of, what if we want to buy voting shares? Well, then we'd have to open up an office in China, and then have a Chinese national operating and running that office, who's a partner with our organization, but isn't owned with our organization. So there's different ways to get involved in international trading. Yes, sir.
Can everybody buy securities from other countries here in the United States?
It's a great question. I'm pretty sure the U.S. is very open. I'd have to get back to you. I never really thought to look into that. I'm very sure that they're very liberal in who can buy and sell U.S. securities. Now, if someone from Iran wanted to buy U.S. securities, I think there's probably embargoes and restrictions on that. But, somebody in Canada wants to buy into the U.S. stock market, I don't think that's an
Because I
issue.
heard that a lot of Chinese people, they buy houses here and they don't even live here.
No, of course. That happens too. Miami is a huge hub for a lot of Latin American people will, buy houses in Miami, right? It also helps in the path to getting residency here too. You don't have to buy a house here to become a citizen, but if you are a wealthy Latin American and you buy a $500,000 house in Miami, guess what? It's going to be a lot easier for you to come back and forth, right? Cost of the front office. The investment advisor fee is the largest expense of the front office. It's about 60 basis points, right? So basically, the people making the investment decisions are the same people making most of the money. Why? They're closest to the money. They're making all the investment decisions. I have a good story that I'll tell you off camera about how being close to the money helps. But I don't want, since I'm putting this up on the web, I don't want to reveal too much. I want to get canned for my job. This PFA is for analysts, portfolio managers, traders, and the tools and support systems they use. Active versus passive management revisited. So, obviously, in passive management, the fee isn't going to be anywhere near as high, right? Because they're just replicating. They're not making any real investment decisions. Okay? Life in the front office can be hectic and stressful. Professional life, never-ending attention to detail, can have long hours, but the monetary payoff can be very high. Okay? Homework, we can ignore that. That is, why did I put the homework in the middle? One other thing I want to talk about is mutual fund supermarkets. Anyone here do the reading and know what they are?
What is it?
Great, it's right on the board. Mutual fund supermarkets, think of like E-Trade or Charles Schwab or Ameritrade, right? They're like a giant brokerage firm that you can just buy a wide variety of mutual funds, right? We don't remember this because all of us here are fairly young. There was a time when if you wanted to buy a mutual fund, you had to go to, the actual mutual fund organization and say, I'd like to buy, so many shares of this mutual fund, right? But, nowadays it's so uncommon to do that. Everyone buys them on these mutual fund supermarkets, these other organizations that sell large amount of mutual funds. So the fund sponsor pays a fee to the operator of the fund supermarket. So if there's a mutual fund run by State Street, right, and they want to sell it on E-Trade, they have to basically give E-Trade a cut of their profits, right? They're going to give them like 0.03% of whatever the transaction is, because they're facilitating the sale, through their kind of pipe of software. Okay. Operator displays and advertises funds and affects transactions with buyers. Schwab was the first operator in 1992. Together with Fidelity, they dominate the market today, providing consolidated statement of holdings to customers. Direct buyers are individuals, but investment advisors also shop there too. So investment advisors can also use these mutual fund supermarkets now. They're so common. That's pretty much all we consider now when we're making investment decisions for ourselves. Pros for a fund sponsor. If we're a mutual fund operator, we own a mutual fund, what are the advantages for us? We don't have to build our own distribution network, right? We don't have to hire like 50 salespeople to sell our mutual fund, right? We sell on the mutual fund supermarket. All shareholder services are provided at low cost through the fund supermarket and can gather assets quickly through good performance. So when your fund's in a mutual fund supermarket, a lot of people chase high returns. So when you want to see what you should invest in, a lot of people look and say, all right, well, which ones have done well? And which ones will they buy? The ones that have done well, right? So if you have mediocre performance, then you're just going to get lost in the shuffle, right? Cons for a fund sponsor, you give up control of customers, right? All your customers aren't handled directly by you. They're handled by the fund supermarket. You give up a portion of revenues, and assets are more dependent on short-term performance, right? So you're very dependent. If you want to get noticed in the fund supermarket, you have to perform really well, in whatever asset class you're operating in. Okay, that's the end of chapter 5. Let me stop the video.